When people hear the word money, what do they really imagine in 2026? Is it paper notes, numbers on a screen, a salary credited every month, or a vague sense of security that somehow feels thinner each year? And why is it that almost everyone uses money every single day, yet so few people can confidently explain where it actually comes from, who controls it, or why it seems to lose value right when life becomes more expensive? What if the way we were taught about money was never meant to help us understand it, but only to help us function inside a system we were never invited to question? And if that is true, what happens when the system itself begins to change faster than our beliefs about it? Think about the first time you realized that money isn't really earned in the simple way we were told. You work, you get paid, end of story. But is it really that clean? Why is it that two people can work equally hard, sometimes even doing the same job, and yet live in completely different financial realities? Why does one country print trillions of currency units without collapsing overnight, while another struggles under inflation with far smaller numbers? How is it possible that money can be created out of nothing, yet your personal finances always feel like there's never enough? These questions are not abstract anymore. In 2026, they are practical survival questions. Most of us grew up believing money was a neutral tool, like a ruler or a calculator, something objective, something fair. But what if money is less like a tool and more like a language that can be rewritten, redefined, and even manipulated depending on who controls the grammar? If money is a language, then who decides what it means? Who decides how much your time is worth? And why does that value seem to change depending on economic cycles that most people never vote on and rarely understand? Here is something unsettling to consider. When you deposit money into a bank in 2026, is it really your money anymore? Or is it simply an entry in a ledger, a promise that can be reshaped by interest rates, liquidity rules, and emergency policies decided far above your head? Why do banks lend out money they don't fully have? And why has this practice been normalized to the point where questioning it sounds naive? What if the entire financial system runs not on stored value, but on confidence, trust, and collective belief? And what happens when that belief starts to crack? For decades, schools taught money as if it were static. Earn, save, invest, retire. A neat timeline. But look around in 2026. How many people actually follow that path anymore? Gig work, digital assets, algorithm-driven markets, subscription economies, and automated decision systems have blurred the line between labor and income. Why does it feel like working more doesn't necessarily mean earning more? How did productivity skyrocket while wages stagnated? And why does the explanation always sound technical, as if complexity itself is meant to discourage curiosity? What if the real lesson missing from schools is not budgeting or compound interest, but power? Because money, at its core, is a system of power. It determines who gets access, who waits, who risks, and who is protected when things go wrong. In 2026, we've seen entire industries rescued overnight while individuals are told to tighten their belts. Why does the system respond instantly to institutional failure, but slowly to human struggle? Is that a design flaw, or is that the design working exactly as intended? Consider inflation, a word that used to sound distant and academic. Now it's part of everyday conversation. Prices rise, purchasing power falls, and explanations often feel circular. Too much money chasing too few goods. But who decided to create that extra money in the first place? Why does inflation act like a silent tax that affects savers more than spenders, workers more than asset holders? And why do people who own assets often feel protected while people who rely on income feel squeezed? What if inflation isn't just an economic phenomenon, but a redistribution mechanism hidden in plain sight? Then there's debt, personal debt, corporate debt, national debt, numbers so large they almost lose meaning. Trillions here, trillions there. But why is debt treated as a burden for individuals and a strategy for governance? How can a country owe more money, and it could ever realistically repay, yet continue to operate as if nothing is wrong? Who is the debt actually owed to? And what happens if repayment becomes impossible? Is debt a chain, or is it a tool, depending on who holds it? In 2026, digital money is no longer a futuristic concept. It's routine. Tap, scan, autopay. Money moves faster than thought. But when money becomes invisible, what do we lose? When spending no longer feels physical, does value change psychologically? Why do people spend more easily with digital payments than with cash, even though the underlying cost is the same? And what does that mean in a world where central banks are experimenting with programmable currencies, where money can potentially be tracked, limited, or conditioned? What if money itself starts making decisions about how it can be used? Cryptocurrencies once promised freedom from centralized control, but now they sit in a complex space between rebellion and regulation. Some see them as speculative assets, others as ideological statements. But what question were they really trying to answer? Was it about technology or trust? What happens when people lose trust in traditional financial institutions and start looking for alternatives, even volatile ones? And what does it say about the system when millions are willing to accept extreme risk just to feel some sense of autonomy over their money? At the same time, artificial intelligence is reshaping markets in ways that feel almost invisible. Algorithms trade faster than humans can react. Credit decisions are increasingly automated. Insurance pricing, loan approvals, even fraud detection are handled by systems trained on past data. But what if the past was biased? What if these systems quietly reinforce existing inequalities while appearing neutral? When a machine decides your financial fate, who do you argue with? And how do you appeal a decision made by logic you're not allowed to see? Think about work again. In 2026, automation hasn't replaced all jobs, but it has changed the value of many. Why does creativity, once considered risky, now command premiums, while routine skills feel increasingly fragile? What happens when income becomes less tied to hours worked and more tied to leverage, platforms, and networks? Why do a small number of individuals and companies capture outsized rewards in a connected economy? Is this a failure of fairness, or a natural outcome of how money flows through systems optimized for scale? There's also the idea of scarcity. We're told money is scarce, but is that true, or is scarcity selectively applied? Resources exist, technology advances, productivity grows, yet insecurity persists. Why? What if scarcity is not a fact of nature, but a management strategy? And if so, who benefits from keeping people focused on survival rather than understanding structure? Savings used to be a safe idea. Put money aside, let it grow slowly. But in a low-interest, inflation-sensitive world, saving can feel like running on a treadmill that's slowly speeding up. Why are people pushed toward riskier investments just to preserve purchasing power? How did stability become synonymous with exposure to markets that can swing wildly on sentiment and news cycles? And why does it feel like opting out isn't really an option anymore? Then there is the psychological side of money, which schools almost never address. Why do people tie self-worth to income? Why does financial success feel moralized, as if wealth automatically signals intelligence or effort, while poverty signals failure? What if these narratives exist to protect the system from scrutiny by turning structural issues into personal ones? And what happens to a society when everyone internalizes economic stress as a personal flaw? In 2026, the idea of passive income is everywhere. Streams, assets, monetized attention. It sounds liberating, but what does it really mean? Is passive income truly passive, or is it simply labor done upfront and disguised later? Who actually has access to these opportunities, and who is sold the dream without the tools? Why does the promise of financial freedom often depend on already having financial flexibility? Look at money across borders. Exchange rates fluctuate, capital flows freely, but people do not. Why is money more mobile than humans? Why can capital escape regulation more easily than labor can escape exploitation? And how does this imbalance shape global inequality in ways that feel abstract until they show up as migration crises, political unrest, or supply chain disruptions? Even time itself plays a role. Money today is worth more than money tomorrow, we're told. But what if that principle drives short-term thinking at the expense of long-term stability? Why do systems optimized for quarterly returns struggle to address problems that unfold over decades? And what happens when financial incentives push decisions that benefit the present at the cost of the future? Taxes are another mystery for many. They feel like a loss, yet they fund the infrastructure that makes economic activity possible. Why does the tax burden feel heavier on individuals than on large entities with complex structures? How did optimization become more important than contribution? And what does it mean for social trust when people believe the rules apply differently depending on scale? As 2026 unfolds, money is increasingly entangled with identity, technology, and governance. Financial inclusion is discussed alongside surveillance. Convenience is traded for privacy. Speed is valued over reflection. But are we consciously choosing these trade-offs, or are they happening gradually, one update at a time, until questioning them feels inconvenient? What if understanding money isn't about mastering formulas, but about asking better questions? Questions like who benefits, who bears risk, and who gets to change the rules when circumstances shift. What if financial literacy isn't just knowing how to invest, but knowing how systems shape behavior, incentives, and outcomes? Imagine a world where people understood that money is not a fixed truth but a social agreement, constantly renegotiated through policy, technology, and collective belief. How differently would people react to economic news? How differently would they plan their lives? Would fear still dominate, or would clarity replace some of that anxiety? In 2026, the biggest shift may not be digital currencies, automation, or new markets, but awareness. The realization that money is not something that simply happens to us, but something we participate in, often without realizing it. And once you see that, once you start asking why instead of just how much, it becomes harder to accept simple answers to complex realities. So the next time you check your balance, or think about your future, or worry about stability, maybe the real question isn't how to make more money, but how money is making decisions around you. And once you start noticing that, it's difficult to stop wondering what else we were never taught, not because it was too complex, but because it might have made us ask the wrong questions, or maybe the right ones, a little too early.